Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons around wealth creation and answer your questions along the way. Click the link below to send your questions in and we can have a chat on this show. I'm Iannuzzelli, and today we're going to talk about savings accounts and offset hacks, where I hopefully am going to give you some really good loaded financial guns to battle the banks and achieve a higher and greater level of return.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
And I really want to talk to you today about offset accounts, the use of offset accounts, how to save additional money with offset accounts. I'm going to share with you a couple of real life stories that I've also implemented with myself to really get a higher level of benefit and stop the banks profiteering off my hard-earned income. But I want to share with you today the very basics of an offset account. Now, we've all seen the stories about how offset accounts work and the level of returns that you get, but I'm really going to break it down to share with you the difference of putting money in the bank and earning an income versus putting the money into an offset account where it's actually saving you interest that you pay. Now, I'm going to share with you an illustration to really break down what income, tax, and net income looks like coming off the back of our net income versus gross income topic, and then really contrast that against the level of return that you can achieve in an offset account, say attached to your own principal place of residence mortgage. Now, again, for anyone out there, a principal place of residence is the property that you live in, you do not earn an income on, and essentially it's a CGT-free or capital gain tax-free item. So I really want to share with you these illustrations now, just to break it down what we're going to be talking about today. Now, it seems to be that I love the $100,000 as a topic of investment. It's a nice round number that shows us pretty good returns when we start to put them in a percentage basis. So in this particular case, again, we're going to choose a $100,000 investment. Now, for anybody listening on iTunes or Spotify, head over to our YouTube video, our YouTube page, and you'll be able to see these level of returns and the illustrations that I'm putting on the whiteboard today. Now, coming back to our $100,000, we have that split now between an interest earning account versus now an offset account against our PPOR. Now, for all intensive purposes, we're going to choose someone with a 30% tax rate. And that 30% tax rate takes you into the middle income earning bracket for most Australians. But this interest earning account is achieving a 5% return, and our PPOR is achieving also a 5% level of interest that we pay. That $100,000 invested at 5% is generating a $5,000 income per year. That's our net yield. We won't go into too much debate about the expenses associated with earning that income. So for all intensive purposes, keeping it nice and simple, $100,000 is invested in an interest income earning account at 5%, achieving a $5,000 per year income. The average person will pay 30% tax on that, and that's going to leave us with a $3,500 per year income on our investment after tax. So not a bad little return. $100,000 invested, getting a 5% net yield. We're going to be paying 30% tax, and at the end of the year, after the taxman collects his certain amount of dollars, $3,500 is what our $100,000 investment has grown to in that 1 year. Now, let's compare and contrast that with a offset account which is attached to our home loan. Now, again, anybody out there who's listening, an offset account is a facility very common here in Australia that the banks have organised and put together, and it's a great facility to help reduce the amount of interest that you pay on your home loan. So it's not necessarily paying down the loan balance does not drop as the offset account increases. The loan balance relatively stays the same, depending whether you're interest only or principal and interest repayments, of course. But it's a great facility that the banks have put together. It's a savings incentive to help reduce the amount of interest that you pay on the mortgage attached to, say, one of your investment properties. Now, I haven't seen offset accounts against any other really asset class in my experience, typically against obviously properties, whether that's commercial or residential. Not all banks offer an offset account. It does come with, certain perks or certain disadvantages like paying package fees. But nevertheless, in my experience, typically speaking, an offset account, when you take all the costs into consideration of having it, is a fantastic tool to help reduce the amount of interest that you pay if you use these particular strategies correctly. So again, we're going to be looking at an offset account against our principal place of residence, which the loan and the interest we're paying on that loan is dollar for dollar at 5%. So again, we're going to be achieving the same level of benefit, which in this case is $5,000. Now, most people say, but Jeremy, I'm not earning $5,000 on my offset account interest reduction. I'm saving myself $5,000 in interest. Now, I like to use the word phantom income because by you not having to spend that $5,000 on interest, it's essentially you saving that level of money and essentially you growing your portion of equity or wealth by what you're saving, which in this case is $5,000. And it goes back to that old saying, a dollar saved is a dollar earned. I want you to really keep that in your mind as we go through this particular situation. Now, the beauty of it is that when we do save money in an offset account against our principal place of residence, which is an exempt tax item, now by paying no tax, that means that at the end of the day, when we're achieving a level of income, again, a dollar saved is a dollar earned, when we're achieving that level of income, it's actually producing $5,000 of savings or $5,000 of phantom income. In this particular case, we're achieving a 5% net yield. So you can see here, when we're looking at these two particular line items side by side, we've got $5,000 invested in the bank, earning a 5% return, where the tax is 30%. That's the tax man taking your hard-earned dollars and leaving you and achieving a $3,500 income, which again, in this particular case, is a 3.5 net percent return after tax. Because tax, yes, we all need to pay it, but I do look at it as an expense. It is a money outflow going out of our bank account. It is a reduction of our wealth. So in this particular case, that $1,500 of tax that we're paying is reducing our $5,000 to $3,500, achieving a 3.5% net yield now after tax. We're again comparing that to the 5% interest that we achieve on our offset account, equivalent to the level of interest that we're paying our mortgage. It's getting a $5,000 savings, which again, a dollar saved is a dollar earned, phantom income, where there is no tax that we need to pay on that level of $5,000 that we're saving. And we're achieving, in this particular case, a $5,000 net income, which is a 5% net return. So you can see how important it is that these little tricks, these little hacks, the savings strategy, the savings plans, getting your financial affairs in order can save you a tremendous amount of money. That $1,500 doesn't sound like a lot, but as you really start to bring that up, as the interest rates change in a very different changing economic environment, the level of returns that you can achieve and receive really start to exponentially grow. So it becomes so important. You need to know your finances. You need to make sure that you've got the right accounts, the right mortgage accounts, the right offset accounts. If you're going to be looking at saving your money, putting it into the bank account in a high interest earning account, you also then need to compare a level of return against an offset account if you have one against your investment property or you have one against your own home. Now, typically speaking, as an accountant, my debate and argument is that we should always try to build up the offset account against our own home first. Once our own home is fully offset, or for instance, we've paid off our mortgage, then we need to start to look at other ways to increase our level of benefit or reduce debt in offset accounts against our investment properties. Or, and I'll share with you a great scenario that my father's done with me many years ago, where it was a win-win situation. I'm also going to be talking about credit cards and the financial gun that they are that can either produce you a substantial level of savings in the future or can be a financial nightmare. It comes down to the discipline, but it also comes down to how you use it and how you use it to your advantage. Because there are some tips and tricks and there are some hacks that can load your gun with the right financial information. So we're going to bring that into consideration right now. And I'm going to share with you those two stories, and we're going to start with credit cards and how to use them effectively. It's a bit of a taboo. People often resonate that credit cards are bad, you don't use them. You know, it's a great way to get yourself into financial difficulties. It's a great way to lose a lot of money. But I think with the right financial disciplines and the right saving strategy attached to it, credit cards can actually work in your favor. Now, we all know about the benefits of credit cards. Yes, you get the great points associated with it. There might be some frequent flyer miles that you get. There might be some discounts that you can achieve at certain retail stores, or there might be points that you can use to purchase goods and services. But I look at credit cards for their benefit of their payment terms. Now, most credit cards, and I'll use the one that I use, for example, it's not great in terms of points. It's a credit card I've had for a lot of years. A little bit of laziness, unfortunately, stops me from changing it. But the way I use this credit card is very simple. I've got 30 days inside that month in most cases, or 31 or 28, depending on the level of days in that month, to transact using that credit card. So I can go ahead on the 1st and spend my money as I will, and then by the 30th, that's when the month ends. The transaction period stops. Now, most credit cards, most banks who offer credit cards, I should say, will tend to give you roughly about 25 days to pay that month off. So in essence, you've got 30 days to transact with that credit card where no interest is paid, and a further 25 days following that month's end to pay the bill in full. So effectively what I'm saying is that 30 days plus 25 days to pay it gives you 55 days in most circumstances to pay the credit card transactions for that month without incurring any interest. Now, how do you say that's a benefit? Well, I'll show you now. If we've got all that money that we're earning from our salaries and wages, or we've got that money that we're generating from our level of business, we can pop that money into our various offset accounts and achieve a level of return equivalent to the interest that we're paying on our mortgage. That means we're having the most amount of money that we possibly can in a period of time in our offset accounts, achieving a far substantial greater level of return than simply keeping the money in our interest income earning account where it is taxed. Now, within that 55-day period, and this is the catch, this is the financial gun that could be the benefit or the loss, you need to make sure that you can pay your credit card in full before that 55-day period comes to an end. If you can do that, you're not giving the banks your 20 or 21 or 22% interest rate they demand, but in fact, you're saving a substantial amount of money in your offset account against your mortgage that otherwise would have went straight out of the bank account at the time that that purchase was made. So again, you're putting as much money as you can into an offset account, achieving a far level greater return, which is equivalent to an interest income earning account, saving you money. And again, we spoke about a dollar saved is a dollar earned compared to that money leaving your account the day that you purchase those goods. But you need to make sure that you've got the financial discipline. If you haven't got the financial discipline, the opposite can occur. You've spent all that money on the credit card. You've also spent that money that's sitting in the offset account as well. And when it comes to our end of 55 days where the money needs to be collected in full to pay the bank, unfortunately, you're in a position now where you go onto a credit card payment plan. And that might mean that you could only make the minimum repayment, effectively then paying the bank, the credit card facility, a 21, 22, 23, or even a 24% interest per annum calculation. So it is so important that if you're going to utilize credit cards as a financial gun to make a benefit and win, you need to ensure that you've got the financial discipline around it to ensure that that 55 days comes up, you're making that credit card payment in full and not giving the banks any extra revenue. I want to take you on now to our second scenario, and this is where I'm going to really draw this. This is a scenario that I've done with my father. He's very lucky. He worked his whole life and he's paid down his home and relatively no debt at all, but he's got lots of savings. Now, the banks at that particular time, and we're talking 3-4 years ago, interest rates from the banks were pretty peanuts, 2%, 2.5% on average. I had some loans. I had some offset accounts against those loans, against investment properties that I had. And my father came up with a great idea. He said, Jeremy, I want to give you some money. Now, this money is not for you to spend. This money is not for you to think it's yours. This is my money. And I can recall this money at any particular time. So if you spend it, think of me as a credit card facility where I'm going to charge you 24% interest. So I said, Dad, not a problem. I'm not going to spend that money. But I want to share with you the scenario that he came up with, and I'll use my $100,000. He said, Jeremy, I've got $100,000 that I can give you, which I can recall at any particular time, but I want to achieve a certain level of return. Now, at the moment, that return that the bank is giving me is only 2%. And at present, your home loan is 5%. Now, this is a home loan on an investment property, so not a PPOR, slightly different scenario, but works very much the same. He said, Jeremy, with that $100,000 that I can recall at any time, we're going to draw up a proper loan contract, which means that it's not your money, it's my money and repayable back to me at that particular time. He said, let's do a deal. I'll give you an interest rate, which is always going to be 1% below your variable rate. So if you're getting charged 5%, you only need to pay me 4. If you're getting charged 6, you only need to pay me 5. But for a level of return, I'm winning as well. How am I winning? I'm giving you a 1% interest reduction on the interest rate that you're paying, but that 1% reduction is always going to be far significantly higher than the interest that the bank is giving me. So in this particular case, my father will be achieving a 4% level of return, and I will only be paying my father a 4% interest. I'm getting a 1% discount, and he's actually getting a bit more of a win, which is a 2% gain. Now, I want to just stress to you that in this particular scenario, it is an interest income for my father, which he will have to pay tax on, and it is an interest reduction for me, which improves my cash flow on my investment properties, which will result in a little bit of additional tax that I need to pay. But all in all, there's a net positive win in these both particular situations, even with tax taken into consideration. So for instance, my father now is achieving a $4,000 income, which is a gross return. Again, there's tax that he needs to pay. And I'm now only having to pay $4,000 in interest as opposed to $5,000. So I'm receiving a $1,000 cash benefit, and my father is achieving a $2,000 cash benefit, and it is a win-win. So for anyone out there, this is a really great topic of discussion, especially across the family or in the household. Now, we'll stress with you, make sure you get your loan contracts, make sure things are all documented accordingly, ensure that it's all done above board, all the relevant taxes are paid where they need to be. But this is a really great scenario where an offset account can be a huge win. Why? Because my father in this particular situation still gets access to that $100,000 by means of the offset account. I can transfer that to him at any time of call. And in his end, he's getting a 2% increase on the level of interest that he's earning from 2 to 4%, achieving an additional 2% or $2,000 worth of net income. In my particular situation, I'm reducing the amount of interest I pay from 5% to 4%, saving me $1,000 per year. Now, again, this $100,000 and level of return associated with it can be amplified as the number grows. So this is just a really good savings plan where there can be a win for both people with the use of an offset account where money can be called back quite quickly. And again, I'll leave it with you and stress that one more time. You need to make sure that all the relevant taxes are being paid, and you need to ensure that you've got all the relevant documentation, because the last thing we want is anything to happen. But I would 100% consult with your financial advisor or one of your accountants. Ensure that this particular strategy can work with you. Have a chat with your parents, have a chat with your family. I probably would say it's not a great idea for friends, but really good if parents really want to help their children by means of giving them an opportunity to save money, while in return, you can earn a little bit of extra money as well. So if you're a baby boomer, this could be a great opportunity to achieve a greater level of return while giving your children a great opportunity to save and not pay too much money to the banks. So they're two really good scenarios of a saving strategy and how using offset accounts can far substantially increase the level of benefit that you can obtain on your cash, and how using tips and tricks like a credit card can not only give you an opportunity of putting the most amount of money into your offset account, achieving the most and highest level of benefit by increasing the amount of cash in your offset account while being in that 55-day payment period. So I hope that's given you a really good understanding of how saving strategies work. I'm Jeremy Iannuzzelli, and that's what schools should have taught you.